Gold just hit $5,000 an ounce. Let that sink in for a second. $5,000 for 1 ounce of a shiny yellow metal that you can't eat, you can't use to power your phone, you can't build a skyscraper with. And yet, right now, the smartest money in the world is piling into it harder than almost anything else. So the question isn't whether gold is expensive. The question is, are you understanding what this move is actually telling you? Because if you miss the lesson here, you're going to miss a lot more than just a gold trade. Here's what you're going to walk away with today. 1. Exactly why gold is doing what it's doing right now in plain English. 2. The real market signals hiding underneath this move that most retail investors completely ignore. 3. A simple framework for how to think about gold going forward, whether you own it or not. And 4. I'm going to tell you about one specific mistake people are making right now that could cost them serious money. I'll get to that in a bit. Hold that thought. But first, let me give you a quick reality check, because I think a lot of people are looking at this gold rally the wrong way. Most people see gold go up and they think, okay, inflation is bad, dollar is weak, people are scared, gold goes up. And yeah, that's part of it, but that's like seeing smoke and thinking you understand the whole fire. There's a lot more going on underneath this move. And when you understand the deeper mechanics, you start seeing these signals everywhere, not just in gold, but across every market you touch. So let's start at the beginning. Why does gold move at all? Gold is what people call a store of value. Basically, that means it holds purchasing power over long periods of time. A Roman soldier 2,000 years ago got paid partly in gold. That same amount of gold today could still buy roughly the same set of goods. Your dollars from 20 years ago, they buy you less. That's the core pitch for gold. It doesn't rot, it doesn't inflate away, it doesn't go bankrupt. Now, whether that pitch holds up perfectly in the modern world is debatable, and trust me, we'll get into that. But that's the foundational reason it exists as an asset. Now, here's where it gets interesting. Gold doesn't pay you dividends. It doesn't generate cash flow. You just hold it and hope it goes up, or at minimum holds its value. So the cost of holding gold is called the opportunity cost, meaning what else could you have done with that money? If you can park your cash in US Treasury bonds and earn 5% interest, risk-free, why would you hold gold that pays you nothing? And this is the key insight. When interest rates are high, gold usually struggles. Because investors say, why hold this rock when I can earn real income over here? But when rates drop, or when real rates, that's interest rates minus inflation, go negative or very low, suddenly gold becomes a lot more attractive. The competition disappears. So let me ask you this. Drop this in the comments. Do you think the Fed is actually going to keep cutting rates this year, or do you think they're stuck? Because your answer to that question shapes almost everything happening in markets right now. Here's where the recent move makes total sense. We've been in this weird environment where inflation stayed sticky, meaning it didn't come down as fast as everyone hoped. But the economy also started showing some cracks. Job numbers got softer in certain sectors. Consumer credit card debt hit record highs. Delinquencies started ticking up. And the Fed has been caught in this impossible situation where they need to cut rates to support growth, but they can't cut too aggressively without risking inflation coming back. So what does smart money do in that environment? They buy gold, because gold is essentially a bet that central banks are going to lose control of the situation, or at minimum, that they're going to be forced to print more money or hold rates lower than they should. Either way, gold wins. Now here's the twist most people completely miss. This recent run to 5,000 wasn't just American investors buying gold. Central banks around the world, China, India, Poland, Turkey, a bunch of others, have been buying gold at the fastest pace in decades. Like record-breaking pace. And when you understand why they're doing it, the whole picture snaps into focus. These countries watched what happened to Russia. When Russia invaded Ukraine in 2022, the US and its allies froze about $300 billion worth of Russian foreign reserves, most of which were held in dollars and euros in Western financial institutions. Gone. Just like that. Locked up. And every other country that has any kind of geopolitical tension with the West looked at that and thought, wait, our money isn't safe if it's sitting in someone else's system. Gold doesn't have that problem. Gold sitting in your own vault can't be frozen by a foreign government. You can't sanction a brick of gold that's physically in your possession. So these countries said, we need to move more of our reserves into something nobody can touch. And they started buying hard. That's a structural shift. That's not a trade. That's not momentum. That's a multi-year, possibly multi-decade change in how central banks around the world think about reserves. And that changes the floor for gold in a way that makes this rally different from previous ones. But wait, I want to be careful here, because this is the part where people make a mistake. And this is that mistake I mentioned earlier that I want you to really pay attention to. When people see gold going up and they hear about central banks buying, they get excited. They start thinking, this is only going up. I need to get in now. They see headlines about $5,000 and they think it's going to $10,000 next year. And some of them might even go buy leveraged gold ETFs or gold mining stocks trying to juice their returns. And look, some of them will be right, but a lot of them are making a classic momentum chasing error. Here's what happens in commodity markets specifically. Big moves attract attention. Attention attracts late buyers. Late buyers drive the price even higher. And then, almost always, you get a correction. It doesn't mean the long-term thesis is wrong. Gold could absolutely be headed higher over the next 5 to 10 years. But buying anything at peak euphoria, right when every headline is screaming about it, is one of the most reliable ways to buy high and then have to wait years just to break even. Look, I've been there. Years ago, I watched a commodity go completely parabolic, thought the move was obvious, got in late, and then watched it drop 30% over the next few months before eventually recovering. The thesis was right. The timing was terrible. I held on and eventually came out ahead. But those months of being down were brutal, and I know I'm not alone in that experience. So what's the smarter approach? Let me give you a framework. 3 things to think about before you put any money into gold right now. First, ask yourself why you're buying. Are you buying because you genuinely believe in gold as a long-term inflation hedge and you want to hold it for 5+ years? Or are you buying because the chart looks crazy and you're feeling FOMO? These are very different decisions. The first one is an investment. The second one is a speculation. Neither is automatically wrong, but you need to know which one you're making. Second, position sizing. Gold is not a get-rich-quick trade. Even if you're right that gold goes to $8,000 over the next decade, that's a fantastic return over 10 years, but it's not going to make you a millionaire overnight unless you're already wealthy. Most financial planners who include gold in portfolios at all put it at somewhere between 5 and 15% of the total portfolio. Not 50%, not your whole savings account. A measured allocation. Third, the vehicle matters. There are a bunch of ways to get exposure to gold, physical gold, coins, bars. You actually own the thing, but you have to store it and insure it. Gold ETFs like GLD or IAU. Easy to buy in a brokerage account. Liquid. No storage headaches. But you're trusting a fund to actually hold the gold. Gold mining stocks, these can give you leveraged exposure to gold prices because if gold goes up, mining companies' profits go up faster. But they also carry all the risks of running an actual business. Bad management, operational problems, country risk if they mine in unstable regions. And then there are gold futures and leveraged products. These are for experienced traders only, not for the person watching YouTube to learn about markets. Now here's where it gets really interesting. And I want to close that loop I opened earlier about what this gold move is actually telling us about the broader market. When gold surges to record highs, it's not happening in a vacuum. It's happening because of a specific set of conditions. And those conditions are affecting every other market too. Let me walk you through what those signals mean. Signal 1. Confidence in paper money is declining. Not collapsing, declining. There's a difference. We're not in some apocalyptic scenario where the dollar goes to 0 tomorrow. But the trend is clear. People are slowly, steadily moving a portion of their wealth into assets that don't depend on any government's promise. Gold is one, Bitcoin is another. And yes, I know, gold bugs hate Bitcoin and Bitcoin maxes hate gold. But from a structural standpoint, they're solving the same problem. Real estate has always played this role too. The takeaway? If you don't have any hard assets in your portfolio, you're making a bet that paper money keeps its value indefinitely. That's a bet that has historically not worked out well over very long time horizons. Signal 2, global fragmentation is accelerating. I mentioned how central banks are buying gold because of geopolitical risk. That same force is reshaping supply chains, trade relationships, energy markets, and tech industries. When the world deglobalizes, when countries start pulling back from interdependence and building more self-sufficient systems, it creates volatility and inflation. Gold historically does well in that environment, but so do other things. Domestic manufacturers, energy producers, companies with pricing power. The macro environment that's good for gold is also telling you something about where to look in equities. Signal 3, and this one's subtle, so stay with me. When gold and stocks both go up at the same time, something unusual is happening. Normally, these assets have a somewhat inverse relationship. Stocks go up when the economy is healthy and people are confident. Gold goes up when people are scared or uncertain. So when you see them both rising together, it usually means one thing. There's a massive amount of money looking for a home. Liquidity is flooding the system, and that excess liquidity has to go somewhere. Now here's a question for you, and seriously, I'd love to read your take in the comments. Do you think we're in a genuine economic expansion right now, or does this feel more like a sugar high? Because the answer changes everything about how you should be positioned. Here's where it gets a little philosophical, and I promise this is worth 1 minute of your time. Gold has been money for 6,000 years. That's not nothing. Almost every other form of money ever invented, seashells, salt, bronze coins, paper backed by nothing, has eventually failed or been replaced. Gold has survived every empire, every war, every financial crisis, every technological revolution. There's something deeply human about the metal. It's rare enough to be valuable, soft enough to be shaped, durable enough to last forever. It doesn't rust. It doesn't decay. And because it's physically real, it can't be conjured out of thin air by a committee sitting in a room in Washington deciding to run the printer. I'm not saying that as doom and gloom prepping. I'm saying it as an observation about human psychology and economic history. When trust in institutions breaks down, people go back to basics. And right now, trust in institutions, governments, central banks, financial systems, is at multi-decade lows across most of the developed world. Gold is the most ancient expression of that distrust, and it's telling you something about the moment we're in. Most people miss this part. They see the number, $5,000, and they think about whether to buy or sell. They don't step back and ask, what does it mean that we're here? What does it say about the world that the oldest form of money on earth is seeing this kind of demand in the age of iPhones and AI and digital payments? That's the more important question. And the answer, if you sit with it, is actually a little unsettling. Let me give you the other side of this argument, though, because I don't want to turn this into a gold commercial. There are real, legitimate criticisms of gold as an investment. One, it has no yield. You get no dividends, no interest, no cash flow. In a world where you can earn 5% risk-free on short-term treasuries, holding something that pays you nothing is a real cost. If rates stay elevated for longer than expected, gold will face headwinds. Simple as that. Two, gold can be extremely volatile in the short term. We already talked about this, but it bears repeating. Gold dropped from $1,800 to around $1,600 in the span of a few weeks back in 2022 when the Fed started hiking rates aggressively. That's almost a 10% drop in weeks. If you bought near the high expecting a smooth ride up, you got a nasty surprise. Long-term trend can still be up while you get wrecked on timing. 3. Mining gold is actually terrible for the environment. I know that might sound out of left field in a markets video, but if ESG factors matter to you, and for a growing number of investors they do, the gold mining industry has a pretty rough track record on environmental impact. Open pit mines, mercury use, land destruction. It's worth knowing. And 4, gold has underperformed equities over long periods. If you go back and look at, say, the last 40 years, stocks have massively outperformed gold, dramatically. So from a pure returns perspective, being overweight gold at the expense of equities has historically been a losing bet over long horizons. The argument for gold is about diversification, about insurance, about having something that zigs when everything else zags, not about it being the best performing asset. Here's where I want to bring it all together for you. The $5,000 gold price is a symptom. It's telling you something about the underlying condition of the global financial system. It's saying a lot of very smart, very well capitalized investors, including sovereign governments, have decided they need more of their wealth outside of the traditional paper money system. That's meaningful. You should pay attention to it. It doesn't mean you need to run out and buy gold today. It doesn't mean stocks are going to crash. It doesn't mean the dollar is dying next week. But it does mean that the era of just setting your portfolio to 90% US equities and ignoring everything else might be coming to an end. Diversification is getting more important, not less. Understanding macro forces, inflation, interest rates, geopolitics, currency dynamics, matters more now than it did in the smooth upward decade of the 2010s. So here's your homework. Literally just one thing. Look at your current investment portfolio, whatever it is, 401k, brokerage account, savings, and ask yourself, if inflation runs hotter than expected for the next 5 years, how does this portfolio do? If the answer is pretty badly, then maybe it's time to think about some allocation to hard assets. Gold, real assets, commodities, inflation-protected securities. Not all in, just a thoughtful slice. Because the investors who do well over long periods aren't the ones who predicted every move correctly. They're the ones who built portfolios that could survive a range of outcomes. That's the real lesson from this gold move. Not whether it goes to 6,000 or pulls back to 4,000 first. The lesson is, the world is more uncertain than it was 10 years ago, and your portfolio should probably reflect that. Let me give you one last thing, a quick and dirty framework I call the 3-question stress test. Ask yourself these 3 questions about any major asset allocation decision you make. 1, what has to be true for this investment to work? 2, what's the most likely way it could go wrong? 3, if it goes wrong, can I survive it financially and emotionally? For gold right now, 1, rates need to stay low or fall, or global instability needs to continue or worsen. 2, It could go wrong if the Fed somehow engineers a soft landing, inflation collapses, and confidence in institutions rebounds sharply. 3, if gold corrects 20 to 30% from here, can you hold through it without panic selling? If you can answer those 3 questions honestly, you can make a much clearer decision than 90% of the people reacting to headlines. All right, last question for the comments, and I'm genuinely curious. How are you positioned right now? Do you own any gold, any real assets, anything outside the traditional stock and bond mix? Tell me below, because I read these and I want to know what you're actually doing, not just what you're thinking about doing. Here's the quick recap. Gold at 5,000 is a signal, not just a trade. Central banks are restructuring their reserves because geopolitics changed the risk calculus. Retail investors are making the classic mistake of chasing momentum at the peak. The right move is a thoughtful allocation based on your actual situation, not FOMO, not fear. And the deeper lesson is that macro forces you use to be able to ignore are now too big to ignore. Understanding them gives you an edge that most people don't have. If this kind of content, real market analysis, no hype, no sponsorships telling me what to say, is something you want more of, subscribe and hit the bell, because I've got a video coming that breaks down exactly what happens to your money if the dollar loses its reserve currency status. Not fear-mongering, just facts and frameworks. And trust me, you want to be ahead of that one before it's all over the news. Gold at $5,000 is wild, but the story behind the number is wilder, and now you know it.